In this video, we will cover the Fibonacci retracement and daily cycle technique. Now, why will we use the Fib retracement as one of our tools as for almost all our trades and entries? Now, the Fib retracement usually gives us levels in the market that will be aligning with order blocks, breakers, and fair value gaps in the market. Now, Fib retracement can give us a good framework of where the market will most likely reverse on a retracement and give us an entry level at order blocks and breakers. Now, Fib retracement is not enough alone in the market as a tool to only trade off Fib levels. We will need additional confirmations such as breakers, order blocks, and fair value gaps. Now, obviously, there are much more confirmations for a Fib level than breakers and order blocks. However, I just want to put into context that how the market can be aligning with other tools and techniques with Fib levels. Now, the Fib level is also a tool that we will use in our daily cycle. Later in this video, I will explain what is the daily cycle, how to use it. I know a lot of you heard about the daily cycle in my free Telegram posts, in my public Telegram. The daily cycle will be the technique we will use to determine the direction of the day. Now, we will get into more details on that later, but just as a context, we will also cover the daily cycle in this video. Usually I have three Fib levels and three type of Fibs that I use for my trading. We can see that I only use actually two specific levels when I'm using a Fibonacci retracement. Sometimes I also use extensions for take profit levels. One in this example and also another one in this example. Now, some of you might be asking what is the difference between the two extension Fib levels? Well, one of them is the most basic take profit levels in Fibonacci techniques. You can align it with old highs and old lows, and these levels will be completed a lot. Now, the one to the side is a little bit different. The only difference is that these are standard deviations, and what those do is one section, so one full standard deviation. It means it's one the retracement that we pull on the Fib will be basically multiplied by the same amount of pips. Now, what that means, if you take a look at it, you can see the level between the 1 and the 0, and this will be multiplied. So that's a standard deviation by that. So these are the standard deviations, and a difference between these levels, that these take profit levels. So again, these are also take profit levels, same as these levels in the extension. However, the difference will be that these ones, so the half, the 1, 1.5, 2, or maybe sometimes even 2.5, 3, or 3.5. Now these ones will be used as target extension levels on the Fib when it's aligning with an old high or old low. Let's say, for example, if this level, the one standard deviation, would be aligning with an old high, pretty much at the exact same level, then we will choose the one full standard deviation. Now obviously there will be more confluence and conformations with the standard deviations. We can also use it with the Asia range. I will also explain more about it, but just as a brief. Now how do my fib levels look? Now these are the fib levels that I will be using and will be teaching in my lessons. Now obviously the 0 and the 1, these are only this is the high and this is the lower. On the bearish example is the low and this is the high. And the most important level for the entry would be the 0.7 up and the 0.62. Now I actually only almost take trades on the 0.62, and the 0.70 is only just to keep a range in the market. So let's go back to the previous example. Now here if you take a look at these levels on the fib retracement, so this would be a discounted price below the equilibrium, and most of my trades will be taken, and most of your trades should be taken on the 62 level. So we are not waiting for anything below the 62% retracement level. So anything below this level, if I'm using the fib, I'm not using any level below. Some people use the 88 or some levels below. I will not be using the 0.70. That's not a level I'm taking trades on. So I'm only focusing on the 62% retracement level in the market. The reason why the 0.70 is placed here is just to give me an approximate range where the market will turn. So usually I mark it up with some kind of box like this. So it gives me an approximate range where I expect the market to turn. Now, how do we use the fib? Now the fib will typically be used, let's say for example on a bullish market, we will use the fib from the swing low to the swing high. So to keep it the most simple, the swing low in the market is a wick that has two higher highs on either side, and the swing high would be a wick in the market that has two lower lows on both sides. Now this is a bullish example using the fib retracement and buying the market at discounted price. Now you will see that the market retraces back to a discounted price below the equilibrium. So our goal with the fib is to frame a level in the market that will be showing us a discounted price level, and that will be the most optimal entry level, the 62%. And again, in this example, you will see how I mark up the fib level as a zone. So for me, the fib level is always a zone. I'm not looking at specific levels. I'm only looking at sort of like an area where I will want to take the trade. Now most of the trades, you will notice in your backtesting that most of the trades are best to be taken on the 62 level. You will become the most consistent if you take the trades on the 62 at 2% level. Now I know many times the market will, especially when you're backtesting, it can confuse a lot of people that a lot of times the market will just go a little bit lower than the 62, like sometimes it will go to a 70 or maybe lower levels. However, I don't really care about that, because if you, let's say for example, would like to take a trade specifically from the 70 level, then many times what you will notice that the market just misses your entry by a few pips. So the best is if you only place trades on the 62% level. Now, what is a swing low and a swing high? Referring back to this example, that you will pull the fib from a swing low and a swing high on a bullish market and wait for a retracement, wait for a discounted price below the equilibrium level. So if you might be asking yourself, what is the equilibrium? The equilibrium is most simply explained the halfway on a retracement. So this black line would be, for example, an equilibrium level. This would be the equilibrium price point between this low and this high. So we focus on buying the market at a discounted price below the equilibrium. Now the swing low will be a wick in the market, usually the lowest level in a move. And how to recognize this pattern? We have a low in the market, and next to it on the left side and the right side we have two higher highs. So here we have 1, 2, 3. So on both sides we see two higher highs. Now this will be considered as a swing low. Now what is not a swing low is a formation that doesn't have two higher highs on both sides. So let's say from this number 1 level this week, I will not be able to use the fib as it's not a swing low. So you will have to find a candle formation in the market that's looking like this. It has two higher highs on both sides. Now the swing high will be having two lower lows on both sides, and you will be pulling the fib the most simple way, swing low to the swing high in a bullish market. Now this is a perfect example of a fib retracement. Now we pull the fib from a swing low level to a swing high, and you see the market came back to the 62% level. Now you will not be wanting to take any trade below the 62% level, and this is one of the examples why. The market usually makes the reaction, and the most accurate reaction, on the 62% level. And notice how this candle formation is displayed here on the market. We have first one low here, and we have two higher highs on both sides. Also the swing high, we have the high here and two lower lows on both sides. So this is a swing low and this is a swing high. So you would not be able to pull the fib level from this low right there. You will have to go to the lowest low. And notice the market only respects, in this case, the 62% level. So I actually had a lot of private messages that some people look at levels below the 62%. But again, this is one of the examples why I'm not taking any trades on the 70 or anything below, as you will miss a lot of trades if you're not taking the entry on the 62 level. Now, this is another example how to use the fib. First, we have a swing low, and also a swing high, and something that will be more advanced in fib use and using the fib is notice that this is the low of the day in the market, and this is the high of the day in the market when before the fib retracement happened. So before this retracement happened, this blue arrow was the low of the day, this was the high of the day. And also notice that the high of the day was the swing high, and actually, excuse me for this, it was a mistake in the chart, so this would be swing high instead of swing low, and this here is a swing low. And again, on the bottom, notice that the two wicks on either sides have a higher high in the market. Now this specific trade will be a daily cycle trade, and I will explain shortly how the daily cycle trade works. But notice that the fib retracement is respecting the 62 level in the market. It also comes down to the 70%. So this is why a lot of people only want to take trades on a 70%. However, if this 70% would just be missed by a few pipettes or a single pip, you would miss this move. So therefore, again, only place your trade on the 62% level. And you can see that the market rallies up, take out an old high in the market. Now a quick summary of the fib levels before we move on to the daily cycle. Now always use the fib from the swing highs and swing lows. So what do swing highs and swing lows mean? A swing high is a candle formation that has two lower lows on both sides. And the swing low is a candlestick pattern that has two higher highs on both sides. Now focus on executing your trades at the 62% level. Now that's the optimal trade entry, OTE, and you will not be wanting to focus on anything lower. Now in hindsight, a lot of times the market will look like it retraces the lower levels, and sometimes you will be wanting to take trades on lower fib levels. However, if you're not taking trades on the 62%, you will not become consistent with your entries. Many times in the market, it's better to just know where the market is trying to move instead of trying to be the most accurate you can be. So therefore, again, only focus on 62% level, nothing else. Now you can use the extension levels as take profits when aligning with old highs and lows. Now your stop loss will be placed below the swing low on a buy and above the swing high on a sell. Now it's not important to put it much below or much above a swing high or swing low when you're using the stop loss. It's just perfect if you're placing your stop loss just at the exact same level where you see the swing high or swing low. Now use the fib as a tool to frame entry levels with multiple confirmations. So never only rely on the fib level, you need several confirmations in the market, such as the daily cycle, a breaker, or the block or Asian range. Now let's talk about the daily cycle. Now the daily cycle is a concept I know a lot of people were really looking to learn, and it is truly one of the concepts that makes my trading very consistent. Now the daily cycle is the concept that made a huge game-changing moment in my career. Now the daily cycle will be a technique that will tell us where the market will be moving for the entire day. And what is the daily cycle? And the daily cycle will be showing us the trend of the day, and the way it will determine as the trend of the day is we will look at how the Asian session and London session moves. Now once we see the Asian session and London session moving in a specific pattern we look for, we will be able to predict the New York and end of the day Asian close accurately, and will determine and find the trend of the day. Now a lot of people have issues with finding the daily bias in their trading. I'm pretty sure that you also had moments when you were questioning what is the daily bias of the entire day. Now with the daily cycle you will be knowing what's the daily bias of the day once Asia range and London session shows its pattern. And in New York Open you will be able to determine very accurately the entire daily bias and the high or maybe low of the day. Now the daily cycle is a technique that will offer us short-term trades only. Now this is not a technique that will be for swing trading or long-term trading or position trading or scalping. The daily cycle is specifically made for day trading. How the daily cycle would mostly look like is opening a trade in New York Open and closing the trade at the end of the day. And this is the daily cycle. Now I know I did post a few examples of this in my Telegram. However, this is now the actual explanation of how the daily cycle works. Now notice what happens in the market. The market creates first an Asia range. Typically we would like to see a tight Asia range in the market. The Asia range usually would be swept by the London Open, so we would like to see the market trade below the Asia range lows. It's not important to trade below by a lot. It's just enough if it trades below slightly, just with a small wick. And London Open would typically rally from the Asia range. So on a bullish example in this case, we would expect London Open to rally in a bullish direction, and in New York Open we will see the market retrace back into New York Open in lunchtime. So in London kill zones. So actually these are the kill zones. I will talk more about the time. So the time of the London kill zone would be 1 AM to 5 AM, and I'm referring to New York time. every time I will be talking about any time reference in the market in my videos or in our later teachings, I only refer to New York time. Now, even if you're living in London or you're living in Australia, you have to look at these times in the market according to New York time. Now, you shouldn't be converting your time. You could be converting your time. However, my advice would be to look at the market according to New York local time. Now, this is only to not confuse anything regarding the time, so we can keep everything accurate and we can just basically stay in the same page. Now let's continue. So London Open would be giving you a bullish expansion in the market. In lunchtime, now lunchtime is actually the short few hours between London and New York Hill Zone. In lunchtime, the market would be making a retracement to New York Hill Zone, and the New York Hill Zone is actually, the time is from 7 a.m. to 11. Now in New York Hill Zone, we would be expecting the market to arrive into our retracement area, and in New York we would be looking at buying opportunities for the rest of the day to continue in the bullish direction. Now this is the entire idea of the daily cycle, and it's just not the idea of the daily cycle, but it's also the idea of the kill zone. I know a lot of people only use the kill zone as a sort of a time where the market is most likely to create patterns, or some people only use the kill zone to look at trading opportunities in that specific time. Now, I believe these guys slightly misunderstood the use of kill zone. The kill zone is specifically used for the daily cycle, nothing else. So what we would be like to seeing in this example, London kill zone to be bullish, create the low of the day, and if London creates the low of the day and the high of the day within the kill zone, we would expect the market to create a retracement back into the New York kill zone, and we would see most likely the market arrive back into the retracement area in New York kill zone, so anywhere between 7 to 11, and we would expect the market to continue into the bullish direction for the rest of the day, and then consolidate back into the Asian range. Now, why is the daily cycle so important? I guess it's really self-explanatory. The daily cycle would be pretty much telling you the entire day's direction for a short-term day trade. And this alone is a technique that will make you very consistent. So once you know this technique, your trading will become so consistent that almost every day or every second day you would be able to see a pattern like this in the market. Now this is an example for the daily cycle. Now it's perfect textbook example, and actually with this technique you will see a lot of perfect textbook examples in the market. Now the daily cycle can also be used as a technique that will be eliminating fake order blocks. So I will be explaining more on that, like the smart money traps, but with the daily cycle we can also filter out and eliminate the smart money traps. Now notice this example that here we have a tight Asian range, we see the market trade below the Asia range in London Open. So again, on this chart, I'm only referring to New York time EST. So right here, we would see the market trade down a little bit below the Asia range, 1 a.m. to 5 a.m. London Open Q zone. And notice that between the 1 a.m. and 5 a.m., the market trades above the Asia range, creates the expansion, it rallies bullishly, and in the lunchtime, which is the few hours between the two key zones, the market starts making the retracement. Now, notice that the market arrives into the retracement area only between 7 and 11 a.m. Now, this specifically was actually 8 o'clock, so on most of your trades you would be expecting 8 o'clock as the specific time of your entry. Now again, notice that first the London Open was bullish, and after the retracement we see another bullish move for the rest of the day. The market takes out on this red horizontal trend line, the market takes out an old high and trades back down and starts consolidating again in the Asia range. Again, London Open created in this example low of the day, high of the day, retracement back into New York Open, and then another rally up. Again, exactly same pattern and example that's happening in the market almost every single day or every second day. Especially if you're looking at multiple pairs, the US dollar currency pairs, you will notice this pattern happen almost every day. This is a different currency pair, so you can see the chart is different. And we see the exact same example happen on a different day. It's the same currency pair, so it was GBP USD. But notice the same pattern happen on a completely different day. We see a tight Asia range in the market. The market trades down. Now in this example I did not mark up the London Open and New York Open, but this is specifically actually London key zone around this area. The lunchtime trades back into the optimal trade entry, 62% level, and continues the day into the same direction that London Open previously created. Again, we see the London bullish rally, retracement in New York, and continue for the rest of the day into the same direction. This is another example. We see the market create the low of the day, high of the day, create the retracement in New York, open field zone, and trade above an old high in the market. Back into the Asia range, consolidation again. Now I can notice this example again is respecting 62% level, so expect to take your trades only at this level. Now, in terms of risk reward and returns that the daily cycle can give you is typically 1 to 3 for a single day. Now I believe a lot of people will be trying to get bigger risk rewards than 1 to 3. However, 1 to 3 is a perfect risk to reward ratio, as with the daily cycle technique, you will be very consistent in the market, and with a 1 to 3, if you are able to do, let's say, 2 successful 1 to 3 trades with the daily cycle technique in one single week, that's 6% for a week. So I believe you shouldn't be complaining about the 1 to 3 trade, especially that how consistent the daily cycle will be working. Now, the stop loss will be placed to the number 1 levels, so the swing low, and the take profit would be most likely, you can target 1 to 3, so you can also use a fixed risk to reward, or you can also target a old high in the market, or a liquidity pool, or possibly maybe equal highs. Again, notice the time and price, how they work. So specifically, London Open is bullish, and we see the retracement back into the New York Open. Again, we see the 1 to 3 risk reward. And usually for the daily cycle, you should be expecting to use a 10, 15, or 20 pip stop loss. Now I am not a big fan of using small stop loss. I believe it will make you inconsistent in your trading, and with a 10, 15 or 20 pip stop loss, you will be much more consistent, especially with the daily cycle, as this pattern usually happens on a 30-minute, 15-minute time frame in the market, and on that time frame, you will only want to be using a 10, 15 or 20 pip stop loss. And again, in this case, we see a 1 to 3 risk to reward ratio. Now, going back to the fib retracement in the beginning of this teaching, now this is why it's so important to learn how to use the fib from the swing low to the swing high, and expect a retracement back to the 62% level, and after that the market rally higher. Now, this is the exact same way that you will be using the fib retracement on the daily cycle technique. Now, quick summary about this teaching and the daily cycle. Now, what to focus on in the daily cycle when you're using this. Focus on London session and London Open telling you the bias of the day. So, for example, if London creates the low of the day, rallies higher, creates the high of the day, you would be expecting the market to retrace in the New York Open and continue for the rest of the day in the same direction that London Open gave you. Now, on the other side of the market, you would be expecting London Open to create a high of the day, drop down, you would expect a drop, and create the low of the day. In New York Open, you would be expecting around 7 a.m. to 11 a.m. New York local time, the retracement in the market and your trade execution. Now, focus on executing your trades in New York Open, especially if you're a developing trader. You will become much more consistent in New York Open trading, as you can implement the daily cycle in your technique. Use the fib level to execute trades. It's not as important to think about other techniques. The fib level would be giving you already a good framework in your setup where your possible retracement and possible reversal would happen. Now, always close your trades at the end of the day when you're using the daily cycle. You wouldn't like to close trades on another day, as many times as the daily cycle completes the pattern, in Asian range you would be seeing a trend reversal in the market. Now, therefore, close your trades always before the day ends. And only use the 15 and 30-minute time frames for this technique, and target a 1 to 3 risk reward when you close the trade. Now, what have we learned in this teaching? The FIB tool will give you a good framework for entries. Now, again, the FIB will not be alone a good confirmation if you're not using other confluences in the market and other techniques. Now, just alone a FIB retracement will not make you consistent. You will have to implement the FIB retracement with other techniques and other confluences. Now, the FIB extension tool is an effective take profit level when aligning with old highs and old lows. The daily cycle will tell you the direction of the day. And the daily cycle will only offer you a 1 to 3 or 1 to 4 risk reward, and do not focus on anything higher than 1 to 4 in the daily cycle. Now, the daily cycle will make you consistent, and this technique will mostly happen every day or every second day.